Okay, still waiting for the numbers which elude us at this point in time. Okay, 4.68 is where it's coming at. So that's a significant reduction from what we saw in the previous month, which was 5.05%. And that would be a multi-month low for the WPI inflation number for the month of Feb. 4.68% compares to our poll of 4.9%. And remember, even the range indicated anything between 4.8 to 5%. So it is way below what any expectation was on the street.
I'll give you the numbers. 8.12% is for food inflation versus 8.80% in the month of Jan. Manufacturing inflation is stable, so that's at 2.76% versus 2.76 in Jan. And primary article inflation has come to 6.33% versus 6.84%. So these are the three main numbers. Fuel and power group inflation too has slipped actually. So 8.75 versus 10% in Jan. So fuel inflation has come down quite a bit. And the December WPI inflation rate has been revised higher to 6.40% versus 6.16%. So just to put it into perspective, the February WPI inflation at 4.68% is better than what our poll was throwing up. So there's a bit more relief than what was expected. And on the food inflation number, Ekta, 8.12%. So this is actually lower than what we saw last month.
Absolutely. The food articles index is down 0.3% on a month-on-month basis. So that is definitely a positive and was expected, Sonia, because the CPI inflation was actually much lower on a month-on-month basis in terms of food. We'll wait by for the core inflation, but I just want to get our economists.
It's at 3.2% versus
the core inflation
3%.
Is, okay. So the 3.2% figure is actually a negative for the WPI inflation, because that means that it's a hardening of around 40 basis points for the core inflation in the past 2 months. So it was 2.8% for December, it came in at 3% for Jan, and it's come in at a hardened figure of 3.2%. This is despite the headline index, which is absolutely, which has actually reduced because of lower food and fuel inflation. I'm going to get Siddharth in on this. Siddharth, what have you made of this? The hardening that we've seen in the core inflation, especially for WPI this month.
I think the numbers are broadly in expected lines. Softening in food inflation was very much expected till this point. Yes, your point on core inflation is right. The numbers are inching up and might actually go up a little more in the next few months as well. You cannot rule it out. But again, the point to emphasize here is it's not totally unexpected. See the things what has happened over the course of the last few months. There had been a significant weakening in the currency till about say 4 or 5 months back, and typically these effects do come into the core inflation with a bit of a lag. I think that process is getting completed now. So going ahead from the rupee side or due to the rupee factor, we are not anticipating any further weakening of the number. The base effect is slightly adverse for the core inflation number, and there might be a little more uptick in the global commodities, etc., with uptick in the global economy. So you might see a bit of inching up in the core inflation headline year-on-year prints. But again, the big point here, that should not be unduly worrisome for us as well as for policymakers.
Okay.
If you take a more holistic picture, what is happening in capacity utilization, what is happening in the overall growth momentum, and it's I'm pretty sure one cannot ignore that. It still doesn't warrant any kind of tightening or something of that sort.
Okay. Well, just one word on the markets. Markets are pretty much unchanged, but the Bank Nifty was down about 2%. It's recovered a tad bit. You should pull up the intraday chart of the Bank Nifty. That's because the inflation numbers are lower than expected. So there is a relief on the inflation front. In fact, it's a 9-month low that we are seeing on WPI. Aditi, come in on this. How would you react to the 4.68% number, and also a little bit of a concern on core inflation?
Yeah, actually the food inflation and the core inflation numbers that you just mentioned are broadly in line with what we were expecting. So they're slightly better than expected numbers as far as fuel and minerals are concerned, if we just sort of do a back of the envelope calculation. Specifically going into core inflation, over the last 4-5 months, we have seen core inflation actually getting revised upwards every time that the revised data is released, and by 20 to 40 bps. So if you actually look at the final data for November, it was around 3%. So essentially you've gone from 3% to 3.2% over a 3-month period, and it is a very mild sort of an uptick. It isn't actually a very drastic uptick at all. And my guess is that possibly the revised number for December also factors in a higher core inflation for that month. So yes, some little signs of strengthening as far as core inflation is concerned, but overall it does remain very much within a comfortable level, and is really not a matter of too much concern right now, particularly given the state of global commodity prices. I think what definitely is going to be much more worrisome for the RBI at this point in time is how the trajectory for CPI is going to play out, both on the food side, which of course is 50% of the basket, as well as core CPI, which as we know behaves very differently from core CPI, from core WPI. And the wedge between the two remains really quite sharp, despite the downtick in the core CPI this month and the slight uptick in core WPI. So I think that is going to be more of a worry at this point.
Sure, Aditi, point taken, but I'm just going to ask you about the core CPI, the core WPI figure this time round. Don't you think in some sense it's actually a positive for growth, indicating that maybe there could be some amount of activity which is taking place on the manufacturing front? We saw that take place in intermediate goods also, which came out for the IIP data, where it came in at a positive uptake for the past 2 months at least. Does that mean that maybe there could be some positive outlook on manufacturing which is taking place?
I think we need to actually carefully slice out the trends within core inflation to see whether it's the domestically oriented sectors that have shown an uptake, or is it the export oriented sectors, because that's really what's been happening in several of the last few months. And then the outlook for exports, as you know, we've already seen negative growth in the month of February. My guess is that we're going to see that in March as well. Particularly on account of the base effect, as well as some of the changes taking place as far as Europe is concerned. So we have to be careful when we really attribute this to an increase in at least domestic consumption or investment trends. Possibly there may be a little bit more of a pass-through taking place, particularly for transport costs, energy costs, as well as the rupee depreciation, although that's likely to be a much smaller component at this point in time. And likely that the export-oriented sectors are continuing to see some price pressures, which should continue until new capacities come on stream. But overall, it may not provide that much support for an improvement in domestic growth conditions.
Okay, just stay on, guys. There's